Yo, what's good, guys? It's Mark out here, and welcome to the section of this course. On this section, we'll be talking about liquidity. Liquidity is what drives the market. If you cannot spot the liquidity, then you are the liquidity. There is a whole lot of concept about liquidity, but as usual, for what we are known for in the Celebrity Traders Club, we try to simplify and try to break down what liquidity is into a layman terms in sort of a way that if you're just new to trading, you will just understand what I'm talking about. Now, liquidity is basically a concept used by the market makers. You know, we are smart money traders. So liquidity is what the smart money traders use in trading. This is what market makers use in trading. So what moves the market is basically liquidity. Without liquidity, I don't think the market can function. What is liquidity? Liquidity is basically where there are pools of resting orders in forms of buy stops, sell stops, and stop loss orders. Liquidity is just a trading term used to describe a market where there are lots of buyers and sellers generating a great deal of volume. Literally, what I'm trying to say is liquidity is where there is a lot of money, and it's basically an area where a lot of people look to take their trades from. Now, if this type of situation happens, then we know millions of people are targeting to make profit from that zone. Then there will be a whole lot of stop loss orders and entries at that liquidity zone. The smart money will look for where there is majority of stop loss, take them out before moving in their initial direction. So in this lesson, I will be showing you how the market makers and smart money algorithm uses these liquidity pools in the market. Once the market takes out liquidity, it takes it out sharply. Once the market grabs a liquidity, it moves back down into the price range immediately. You see aggressive moves or spikes while they are grabbing this liquidity in the market. You understand? You'll be wondering if there is news or something like that, but no, that's just smart money for you. Because the volume, why that spike is like that, they want to grab the liquidity there very, very sharp and then move the price immediately. Once they grab your SL, they don't want to give you a chance to move inside the market. That is why as a retail trader, they keep taking out your equal lows before price goes in your favorite direction. You will see that price pierces these levels and then moves away immediately. Now, as smart money traders, these are where we want to be taking our trades. When retail traders are going out of the market, it is when we are entering the market. It sounds somehow if you are a retail trader and you are hearing this right now. Yes, it's true. This is how the algorithms work. This is how smart money traders, this is how they work. Now we have two sides of liquidity. We have the buy side liquidity and we have the sell side liquidity. Now, what is the buy side liquidity? Buy side liquidity is a pool of buy stops orders with their respective stop losses. When the buy side liquidity is being taken out, that is, the buy stops are being activated, the market immediately reverses to the downside to activate the stop loss of those buy stops that it activated earlier on when grabbing liquidity. Now, there are two types of liquidity resting above a particular level. It's resting above in forms of sell stops or buy stops, and also in form of stop loss orders. Buy stops and sell stops are basically ways you can enter the market if you don't want to use an instant execution. Basically a type of pending order you put in the market. When once price activates that, it moves in your direction. Now, buy stops and sell stops are basically pending orders. So this particular type of pending orders are considered liquidity in the market. As smart money traders, we don't use buy stops and we don't use sell stops because we consider buy stops and sell stops as a form of liquidity. What we use as smart money traders, we basically use the sell limit and the buy limit. But the buy stops and the sell stops, we don't use that because we consider that to be liquidities in the market. You understand? Now, we also have the sell side liquidity. The sell side liquidity is a pool of sell stop orders, that is the pending orders, with their respective stop losses. When the sell side liquidity is taken out, sell stops are being activated in that process. Now, the market reverses to the upside, clearing the stop loss orders of the sell stops. Now, I'm going to explain this in details. This is buy side liquidity. Now, buy side liquidity. Where to spot out buy side liquidity? You can find your buy side liquidity at previous month high. The previous month highs, there will be a lot of stop loss orders resting above that high, and there will be a lot of buy stops resting above that high. Previous week highs, previous day high, high of the day, all highs, and equal highs. Now, as an intraday trader, these first two might not be of important to you that much, but it's still of important when you are doing the higher time frame analysis. But the previous day high, the high of the day, the all highs and equal high, especially all highs and high of the day and equal high, is what you'll be using more often in the marketplace, because every day you will always have an all high in the market. You always have an all low in the market. Explaining this, when I said when the market clears out liquidity, buy stops are being activated, then it reverses down to take out the stop loss orders. Now, this is what I mean. Now, buy stop orders is a simple tool in the market where you use in entering. If you don't want to enter with an instant execution, you can use the pending order tool, which is the buy stop. How do you use buy stops? Now, there is what we call breakout traders. Breakout traders are basically traders that want to see price break out of this place, this high. Once price breaks out of this high, they expect price to go higher. If the market was going an uptrend, breakout traders want to see the price break out of this place, so their orders will be above here. This is where they put their buy stop order. Their buy stop order will be here. Now, when their buy stop orders is here, because they want the market immediately it breaks out, it breaks off this high, they want the market to actually break out and activate their orders here. Do you understand? They want the market to break out and activate their orders. Once their orders have been activated, they want to see the market rally off from there, then take their profit somewhere here. This is how breakout traders trade, and breakout traders in the market is basically considered as liquidity. Once a breakout trader, a buy stop order is being placed here for the market to go high, where do you think the stop loss order will be? The stop loss order is going to be below here. The stop loss order is just going to be below this, because this is how breakout traders trade. Once it breaks out, they want to keep their stop loss order here. Now, what do market maker, what do they do? What they do is, since there are a lot of orders resting here, they will break out, activate that buy stop, putting in the order in the market. They'll activate the buy stop, then move a little bit, then come back down to clear their stop loss. Now, clearing this stop loss helps move this price drastically to the downside, because stop loss orders basically helps fuel price movement. Now, the market makers only sell to stop loss, or they only sell and buy to stop loss orders. That is the only thing. They target the stop losses in the market. It's not that they know where they can see it on the chart. They look for obvious zones where these things are being placed. And where do you spot this place? I said previous month high, the previous week high, the previous day high, high of the day, all highs and equal highs. Where do this set up the entry model that I show you from? When you are looking for these ideas on your charts, where would you expect them to appear in price? You expect them to appear in price at this price level, previous month high, especially old highs and equal highs. That entry pattern that I showed you, after all highs have been grabbed, that is when you start being interested in the market. Let's say this is a bearish bias now. We have our bias for the day was meant to be bearish, and we spotted out all highs here. What did I say we want to see? You have a level of relative equal highs or all highs, which is here, and price is moving towards it. Before the kill zone, price is moving towards it. At that moment, as soon as it goes above it, you start making out the nearest short-term lows and expect price to break the low with an energetic move. Also, you need to understand that there are also sellers in this market, people that were selling here. And so I told you there are two types of liquidity resting above an all high: stop loss orders and buy stops. Now, stop loss orders is basically the stop losses of people selling this market. Now, when the price come back up, there will be enough people in the market. Retail traders will be trying to sell this market here. Now, what you often see is that when price comes here, the market is going to trick them, give them, not spike up like this immediately, just give them a little bit of move, then zooms off and clear out the stop loss that was resting. Because when they start seeing here, they'll take sells and then they'll keep their SL right above here. And now, this SL and these buy stops that rested above here fuels this price, helps price move lower. Now, this is the concept behind buy side liquidity. Now, sell side liquidity is basically the flip side of the story. Where to spot out your sell side liquidity: previous month low, previous week's low, previous day low, the low of the day, the old lows, and equal lows. Now the same thing here, there will be sell stops resting here. Breakout traders want the price to break out of this zone, activate their orders, then go lower. Now what market makers do, they come back, they come here, break out, activate the sell stops, move a little bit, giving them hope in the market, then reverses to take out their stop loss. Every sell stop that was resting above here has a stop loss above here. The market makers is basically activating this sell stop so that the stop loss orders of this sell stop will be open, so that they can come back and trigger that. Remember, I told you they are targeting your stop loss. The idea here is for them to activate the sell stops, then come back and clear the sell side liquidity. Do you understand? So this is basically what happens here. And this is where you want to be buying as a smart money trader. Now, if you've analyzed your day and your day is bullish and you understood that the candlestick of today's candlestick, the daily candlestick, is going to expand higher, you want to see this happen in the marketplace. You want to see price activate these sell stops. You want to see price take out this liquidity, then move back up into the market. This is where you want to enter your trade. Now, I'm going to show you example of these things on the chart so that when you go to the chart, you understand what I mean. Now, buy side liquidity. Now, this is a chart. This is an uptrend. Obviously, this is an uptrend. Now, this is the buy side liquidity here. Now, what will be resting above here is basically stop losses of people that are selling, that sold this market here. There will be stop loss resting above here, and also there will be buy stops here. What will be resting above here is buy stops. Remember, I told you buy stops is basically breakout traders. What will be resting here is the buy side liquidity and stop loss order. After price have grabbed this liquidity, what happened here? You see price moved lower. The breakout trader that was here have been taken out. Now price trades, take out this liquidity, and then you see price move lower. Once price takes out buy side liquidity and then trades lower like this, it targets the sell side liquidity that it has created. If you are selling here, where do you want to take out your profit? This level here, sell side liquidity. After buy side liquidity have been grabbed, we are sure that sell side liquidity will be grabbed. You understand? So as smart money trader, this is how we operate. This is how price is delivered. This is how the algorithm deliver price. We don't want to sell double top. We are not selling double tops here. We're not retail traders. We won't be selling double tops here. We won't even be selling trend line. If you connect trend line from here to here, you will see that this has killed the trend line traders too. If you are connecting trend lines from here to here, you will see that this alone have killed the trend. So all these retail concepts is basically liquidity in the market. But we are not focusing on the trend line liquidity because our strategy is not built on that. We are not focusing on that. We are just focusing on old highs and old lows. Once an old high is being grabbed, expect your pattern to form here, either on the lower time frame or on this particular time frame. Now, this is just a bonus tip, the Asian liquidity. I won't be going deeper into this. You have to go on your chart and look for this. Now, I want you to prove me wrong by going into your chart to look for these things. Just go into the chart and look at these things. The Asian range is basically consolidation. You see price consolidate. What happens here is, what is happening here when you see a consolidation? Equal highs are being created and equal lows are being created. What is rested above equal highs? Buy stops. Stop loss orders of these sellers. The person that sold here, their stop loss will be here. And also buy stops of people that want to go long. What will be resting below these equal lows? Sell stops and stop loss orders, the SLs of people buying this market here. Now, what the price do? Obviously, as a smart money trader, price takes out the highs here, grabbing liquidity, takes out this high here, grabbing liquidity, grabbing the buy side liquidity. After grabbing the buy side liquidity, where do you expect price to go to? Price targets sell side liquidity. After the buy side liquidity has been grabbed, it targets the sell side liquidity and grabs the sell side liquidity, and then price rallies back up after grabbing this. So if you had your buyers for the day being sells and price was here, price tries to navigate it. You want to see price break up first. If you had a consolidation and your bias is sell, you want to see price break out, tap into a zone, give your entry pattern inside here, and then you take price lower to attack the sell side liquidity. Now, if you're a buyer, you want to see price break out here, attack the sell side liquidity, tap into a zone here, then leave behind an entry pattern for you here, then move to the upside. The simple thing I just want you to get in your head is, if you are a seller, you want to see buy-side liquidity being taken out. You want to see buy-side manipulation. If you are a buyer, you want to see a sell-side manipulation first. Don't rush into the market. So yeah, this is all you need to know about liquidity. So I'll catch you guys on the next session of the class.